Crompton Greaves. Now that came out with its numbers, and the CFO of the company is joining us to give us more insights on how the quarter gone by. Now, in the second quarter, if you see, sir, the margins were a bit of disappointment for CG Consumer as per the analyst reports that we have read. Can you just take us through what were the reasons behind this disappointment and how is the outlook looking like?
Hey, hi, good afternoon, and thanks for the opportunity. Let me give you a perspective on how the margins have moved in the last quarter to start with. See, if you take ECD as the segment there, sequentially, we have improved our margins compared to the previous quarter, but we are coming off a significant energy rating transition that happened for our fans business, which is our largest in the portfolio. Fans as a category post the BEE changes, where you had to make mandatory star rated fans from 1st of January, had to undergo 15% increase towards the input cost. Part of it we could offset by some of the value engineering activities that we could do. Some of them we are trying to offset with further price corrections and cost reductions that we need to work upon. This is an ongoing journey, considering how the industry has been and how the demand scenario has been panning out for last few quarters. We have been taking calibrated calls in terms of price increases. As we look at the outer quarters, a combination of price increases and the cost reduction initiatives that we are working upon will help us to structurally restore our ECD margins. Coming on to lighting, I'm very happy to share that lighting has structurally improved its margin both in absolute and in percentage. Our EBITDA margins have expanded on our lighting business by about 250 basis points. This is again driven by better sourcing strategies on raw material and the value engineering that we have done in terms of our product profiling. Coupled with this, EBITDA in absolute has also grown in our lighting business. We could see almost an 80-20% growth in our absolute EBITDA for lighting, which makes us fit for growth. We know that as a category, lighting has got challenges. Now, with this being there, will help us to reinvest back and drive growth. Fundamentally, once as we are getting our structural margins right, as part of the Crompton 2.0 strategy that we have laid out earlier this year, our imperative is to drive growth and ensure that we create value for shareholders with the right level of margin rather than moving towards a profitability expansion. So we think in the long run, having a stable EBITDA margin, which can actually drive absolute profit growth, backed by double-digit revenue growth, is something that can create value for all shareholders.
Okay. When it comes to the ECD segment, now, despite the weakness that we had seen in the industry, companies' growth was stable enough, in fact, better than the industry growth. But how is the outlook looking like, given the fact that we are now entering in the festive period?
See, historically, if you look at it, our ECD portfolio led by fans, the share of premiumization that we had was probably lower than the industry average. Consciously, we have taken a strategy where we wanted to focus on increasing premiumization. This is led by innovative offering that we have come out with both the induction and BLDC segment in fans category. As we look at the outer quarters, we do think our premiumization journey will continue, and that should help us to sustain our growth momentum as we look forward for fans as a portfolio.
Now, sir, moving on to that merger with Butterfly Gandhimathi, which was actually called off because you did not get majority of approval coming in from the minority shareholders. Now, what do you think, as per you, would be the reason behind this vote that has come in against the merger? Is it purely because of the share price disconnect?
See, end of the day, we need to respect the decisions of the shareholders. If you look at the majority of minority divided into two buckets, one is institutional investors and second is non-institutional investors. Institutional investors have voted in favor of the deal within the minority. It is the non-institutional investors who have not voted in favor of the merger. Now, price is a relative thing. We need to look at both the companies together, Crompton and Butterfly, and do what is fair to both the shareholders. And this entire swap ratio, as you would know, was arrived with the expert opinions coming in from Big Four players, and it was backed by investment bankers, where we put across what is the rationale towards it. SBI Caps and Kotak had vetted it, and then the board had approved for us to go ahead with this. Subsequently, if the non-institutional investors are not comfortable with it, we do respect their decision. But as we stand today, we want to operate Butterfly as a separate listed entity for the near future. We don't think we are in the process of relooking or reinitiating merger anytime soon at this point of time.
That you won't be reinitiating the merger anytime soon. Does this mean that the management bandwidth or would be divided between these two companies? Because this is one of the concerns coming in from the investor community. Apart from that, also what we're understanding is that earlier there were some synergies that were supposed to happen because of the merger. Now, now how does this go through going forward?
Yeah, sure. See, fundamentally, if you look at it, we have separate business leaders leading each of our verticals. So we have a BU head with full P&L and balance sheet responsibility for fans, which now we call it as home electricals, where we have combined fans, geysers, and coolers. Similarly, we have a BU head who is independently responsible for Butterfly as a business. And from a kitchen perspective, that's our single largest category that we operate in. So we don't think so there is any challenge on a bandwidth perspective, considering these are independent teams working on their respective portfolios. So that's not the case. Coming on to the revenue and cost synergies that we have been working upon, as you would be aware, it's about 18 months since we have announced or acquired Butterfly in March 2022. There were two work tracks that we had started to work upon. One, which is to integrate Butterfly from a business perspective into Crompton. And the second one is how do we need to look at the legal integration, which is only a near-term activity that we took on from March onwards. So for the last 18 months, we are clear on how do we operationally integrate irrespective of the merger, and how do we ensure that the cost and revenue synergies continue to accrue, whether the merger goes through or not. So in this scenario, now that the merger is not going through, we are not adversely impacted by the cost or revenue synergies that needs to accrue. That will continue to. We don't see a challenge there. Whatever that we need to operate and incur costs towards operating this as a separate listed entity from a statutory aspect is pretty minimal in nature, and that's not something to be concerned about.
Thank you, sir, for giving us those details and putting things into perspective.